Good morning, Jags. This is Fahad. Today is Wednesday, December 9th. Let's get started. Going to have discussions on several stocks this morning with fire, basically as fast as I can run through all of them, but quick updates on many, because I believe that many Jag clients either have positions in them, or if not, then they would have some interest in these stocks. So let's start off with Activision, ATVI. Fantastic technical breakout in the last 2 days, continues to push higher on heavy volume, clearly gunning for new 52-week high. So closed at 83 yesterday, but I think that at this point, with the technical view that's in front of us, with the MACD rising, RSI rising, volume surging, this is easily going towards $90 per share. Quick update on this one. Here is the World of Warcraft, this is the expansion pack, which was launched not too long ago, just a couple days ago. We now have channel checks on this one. On day one, which was just a couple days ago, the new World of Warcraft expansion packs of Shadowlands sold 3.7 million downloads on a single day. Why is this important? That 3.7 million downloads in a single day. For the entire fourth quarter of 2020, the street is modeling 4.1 million units. So you can see that they're already at almost like 85% of what the consensus is for the entire fourth quarter. Now, I understand that this was launched very late in the season, because this is already December, so they don't have much more time, only 3 weeks before the year is over. But clearly, they're going to surpass the street estimate for the fourth quarter for this expansion pack, which should be very positive for the fourth quarter earnings. And I believe that's why the stock is responding positively and is starting to break out. The consensus estimate should start to move higher for the fourth quarter earnings with these channel checks coming out. And if they don't, then when the next quarter earnings report comes out sometime in February, we should see a very clean beat and raise at that particular time. So that's on Activision. Next one is BIDU. We just covered this yesterday in Conversations video, as I presented the bull case, or reiterated my bull case, which was presented originally in webinar last week. This stock is once again gapping higher. Yesterday's gap higher did not hold. It basically faded after the market opened, and then today once again it's gapped higher. The reason is that the same message that I highlighted is now resonating with the Wall Street research. So UBS this morning is sharply raising its price target from $130 to $190 per share. That's a very big hike. And the UBS analyst says that they see the core revenues, including search and feed advertising, is turning positive due to product improvements, a stabilization of the competitive landscape, and easier year-over-year comps. They also go on to say that they see significant amount of value that's to be realized in other businesses, such as autonomous driving, cloud and smart speakers, via stock listings, selling and spinning assets, as well as share buybacks after the company increased the share buyback program from $3 billion to $4.5 billion yesterday. Same exact thoughts that I have been talking about. All the side investments the company has been making for several years are now starting to materialize, particularly in the autonomous driving. And core search has also now inflected positive on a year-over-year basis to now up 10% from very significant downfall that we saw in early part of this year. So let's see, if it didn't break out yesterday, didn't hold the breakout level, let's see if this will run today. The stock is looking to gap higher above $147 per share. Next one, DraftKings and PENN National Gaming. There was incredible strength in both of these stocks yesterday. We pointed out heavy call buying in DraftKings. We talked about significant amount of call buying in the January 50 and 55 and 60 and 65 and all the way to 70 strike calls in DraftKings. And similarly, PENN National Gaming saw heavy, just as the start started to break out from this fantastic technical resistance over here through $75 per share. We saw tons of weekly call buying that picked up in PENN National Gaming. First, they were buying the 70 strike calls, then they moved up to 75 strike, then they started buying 80, and then later on towards the end of the day, they were buying 85 strike calls, all short-term as well as long-term. A quick update on this one. We may now know exactly why there was a potential rally in this sector yesterday. This note is actually from December 8th from Credit Suisse, but it's an important one in which they talked about. So this is actually yesterday morning, and I think this may have sparked the rally. There's an update on Ohio legalization effort for sports betting. The Ohio state officially introduced a bill yesterday called SB 111 that will legalize online sports betting with 1 online skin per casino versus 3 in the prior bill. This is being done to expedite the process, and it sounds like that the momentum is building behind this bill to pass before year end. By the way, the same exact thing is happening in Michigan as well. So both of these states are working together with their House and the Senate to get this thing done before the end of the year. And there are certain dates you need to keep in mind, which is December 9th, which is today, December 10th, which is tomorrow, and then next week on December 16th and 17th, and also December 22nd. There are 5 legislative calendar dates before Christmas when this bill could potentially pass in the state of Ohio, legalizing the sports betting. I believe these are similar dates that we have in the state of Michigan as well. So in the next 2 weeks, we could see this legalization happen in both of these states. And as a result, I said this in the chat room yesterday, that would be a very, very positive catalyst for both of these companies. And I believe that's why these stocks are suddenly starting to respond positively, as we saw yesterday. Number 4, YETI, YETI. This stock has been on a tear for the past month or so. Another power candle yesterday, another new 52-week high, continues to break out ever since it left behind this major VOP resistance. Just a reminder that back on September 13, right over here, Jay presented a fantastic bull case on YETI Holdings. And if you go all the way down, where did it go? Right over here. You can see, and this one talked about significant amount of channel checks, particularly taking it from KFL data. They showed that the credit and the debit card spends for YETI.com was showing 105 to 115% growth rate for the third quarter to date. And that's what it was. It was a channel checks from KeyBank that led us to issue this bullish idea on YETI Holdings. This was back in September, and the stock has been constantly running strong since then. I have more updates at this time. Now we have further channel checks about Black Friday as well as Cyber Monday. And it seems to me that the growth has further accelerated. Now they're looking at 139% year-over-year growth rate when you aggregate both Black Friday and Cyber Monday. These channel checks from debit and credit card spending coming from Bank of America this time. Last one was from KeyBank. So we went from 105% year-over-year growth rate to now 139% during this holiday weekend. And this is another endorsement that this company is having a fantastic Q4. I will also show you this another picture of how this YETI web traffic is surging sharply. You can see how November was another record month. Visits and on a year-over-year basis continue to sharply spike. So this is very, very positive. So if you have a position on YETI, ever since Jay presented that bull case on September 24th, this was when, by the way, the stock was trading at $45 per share. It now trades at $67 per share. It's already up over 50%. But with the technical momentum like this, and as well as channel checks like this, stay with the momentum if you have a position, because these are very, very strong until the momentum starts to fade essentially, and it starts to respond, it stops responding to good data. So there's that. And the last stock I'm going to discuss real quick is SYNH, Syneos Health. Now, some of you may remember this one, and some of you may have forgotten, but back on July 22nd, I presented a bull case for this stock, SYNH. This was at the time before the earnings report was coming out. This was a podcast that you can listen to in Spotify. All right. All you have to do is go to Jaguar Java, Spotify, and then a podcast channel. And then from there, you can find this podcast from July 22nd and listen to it. But back then I presented an earnings preview as well as a long-term view for Syneos Health. I bring this up for two reasons. One, because this chart has not worked since then, but watch this one closely. If you look closely right now, this is potentially starting to attack all of this major VOP resistance level right around here, around $66 per share, all right? And recently, the volume has sharply surged. There was a bit of a gap down on concerns about the medtech. Remember, we had a healthcare scare a little bit a couple days ago when the CMS ruling came out affecting certain medtech stocks, and that caused a little bit sell-off in Syneos Health for some reason too. But immediately the stock came back, and so ignore that gap down for a single day. Volume has been surging. Stock is attacking major VOP resistance around 66. Let's see if it starts to break out through that. There was an analyst day that happened yesterday, and the takeaways from that are actually quite positive. Let me read some quotes on this one. Credit Suisse points out that Syneos Health unveiled medium-term guidance calling for revenue growth of 8.5% year over year for each year through 2023, which is reflecting an above-market growth across both of its important platforms, which is the clinical platform, in which they see high single-digit growth, as well as commercial platform, in which they see greater than 5% growth. And along with that, they also see about 50 basis points of annual M&A contribution. Management did not talk about exactly what they have in the pipeline to acquire in terms of M&A, but they're directionally moving in that path where they're looking for small tuck-in acquisitions. They also talked about they expect to see EBITDA margin expansions of between 30 to 50 basis points, which will support an EPS on earnings growth of about 16% year over year for the next 3 years. And they also see that they disclosed their 2021 guidance, which is now looking for 18.6% growth rate versus consensus estimate of 16%. This was all discussed by Credit Suisse in this note that came out. So some of these notes are very, very important, particularly this line right over here. It also updated previously disclosed guidance for 2021, 18.6% growth at the midpoint versus 16% estimate. It's a very differentiated story that does not get enough mention. It's and there's a lot of positive elements that are going over here. But I like this guidance raise. Finally, the street is starting to warm up to this name, and technicals are started setting up for a breakout. So check out my podcast from July. Much of the bull case that I mentioned back then is now finally starting to come into picture. And that's it from me. Jay?
Morning, everyone. So actually, first off, just a quick note on Activision. Next week, Wednesday, December 16th, Black Ops Cold War will be releasing season 1. So this is going to give people new maps, new Warzone map, and it also allows players to buy the Battle Pass, which ultimately gives them, new weapon camos, new character skins. And I don't know how much that costs, but nonetheless, it is a transaction for individuals. And then Cold War is also opening up the store for just individual bundles. So needless to say, microtransactions should go up starting next week.
Good to hear that.
And then the stock that I want to highlight today is Ritchie Brothers, ticker RBA. The company held its investor day on Monday, and there's been some commentary that's come out yesterday and even this morning. So a few highlights from that event. The first was on just the overall growth markets. The company is committed to increasing the proportion of sales from US and international markets, but in particular, the US is currently underrepresented at around only 2 times Canadian revenue. So there's still plenty of runway here in the US. The second highlight, and really the most important one, was how RBA is expanding and refining its use of data collection and analytics to provide heavy equipment owners with better strategic advice on managing assets. RBA is looking to expand its service offerings to adjacent industry players. And the Rouse Services acquisition that it did back in late October for $275 million is going to be vital to these initiatives. B of A specifically is out with a note today with the sort of the headline, IMS is the home run. They say the game changer that unlocks significant growth is RBA's inventory management system. It's an ERP-like system for the equipment industry that provides access to RBA's and Rouse's rich data. So RBA is no longer focused on converting all transactions to auctions. Rather, it's providing a range of services to help support fleet management. The Ritchie Brothers Financial Services segment, that success has provided them confidence that it can capture other big service buckets, such as inspections, which is 2 to 4 billion, parts and services, which is 100 to 150 billion. And if you look at this, figure in front of you, there's a $300 billion gross transactional value market. In Q3, GTV was up 22%, and that came in at 1.3 billion. So, you don't need a math degree to figure out that there is so much more runway for this company when it starts to use Rouse services to, as I said, expand into these different segments. And the final thing that CIBC highlighted was that they're using some pilot projects right now to improve their sales processes and finding new growth avenues. Specifically, they have a Texas project right now that realigns their sales approach from a one-size-fits-all territory manager to 3 specialized sales managers. And then lastly, there's an initiative that started in Australia where RBA is using satellite yards to provide market access for smaller buyers and sellers. But IMS is essentially the thing you want to focus on right now, simply based on this chart that you see in front of you.
This is incredible. They really increased their total addressable market size by a milestone. I mean, we have never looked at this company in the past as more than just an auctioneer of commercial equipment and stuff. And basically, from all the coverage in the past, we have looked at this company as somebody that organizes these massive events, physical events on, they basically rent out these large lots in Florida and Texas and other places, and they will fill up with thousands of people and put out all of these equipments, transport everything there, and then do a massive auction. And they would do it like 4 or 5 times a year, aside from small ones that would be regional. And now with the push into digital, they've just gone completely in a completely new spectrum of all kinds of services, advertising, global listings, and appraisals, inspections. There's a quote, and I don't know exactly word by word how it goes, but there's a phrase that's commonly used, which is, good businesses go something like that. Good businesses, good businesses figure out how to survive a downturn. Great businesses figure out are improved by a downturn, something like that. Great businesses are improved by a downturn, and it comes down to the unique management style that basically takes the opportunity that's in front of it at a time when the market conditions are changing, which is what happened during COVID environment. And this company figured out exactly what they needed to do this year to improve the business, and chart speaks for that. Incredible stock, very powerful name. We got to watch this one going forward from here. This could still be a much bigger opportunity with the kind of addressable market size they're talking about, even despite all of this run. Good stuff. Chronicle.
Morning, Fahad. So last week on Friday, I talked about how e-commerce and digital sales will be here to stay even if economies start to reopen. And that what the pandemic has really done is that it's forced a lot of companies to bring forward their plans to build out their online presence, because they were eventually going to invest in e-commerce anyway, but they just never got around to it. So this is a theme that I'm bringing to our upcoming quarterly outlook discussion next week. And I've narrowed down my list of potential ideas related to this theme to 2 companies. But between these 2, I have to pick one to go with, because I don't want to be bringing 2 ideas that are highly correlated and probably going to move in tandem. So what I've decided to do is I've picked the one I'm going to go with. But as for the other company, I'm going to talk about it right now. and the company is Channel Advisor, for which the symbol is quite appropriately ECOM.
Yeah.
What this company does is they provide all sorts of subscription-based channel management solutions for online sales and marketing. This also includes fulfillment, inventory, and analytics. So in essence, they are not Shopify, nor are they trying to be Shopify, but rather this company is creating a niche for itself where their offerings can be overlaid on top of the basic e-commerce infrastructure. So in reality, they don't compete directly with Shopify, BigCommerce, Salesforce, Adobe, and so on. And going forward, I think this stock has some potential upside, mainly for a couple reasons. First one is, I would say don't be put off by the low double-digit revenue growth rate that the company has been reporting, because I believe this is about to inflect higher. Because for several years prior to the pandemic, one thing that this company had been struggling with is customer retention, mainly because management failed to invest enough in customer service and support, which resulted in some dissatisfaction and churn. But now it looks like they're starting to get their act together, because over the past year, management has taken a lot of specific actions with regards to improving their service levels and customer relations. Now, to save time, I'm not going to go into all the specific actions that they've taken, but I will say that it's starting to show, because even though the revenue growth looks quite low considering the boost to e-commerce from the pandemic, if we look under the hood, we can see that bookings have started to increase significantly, reaching 6-year highs, and their churn has begun decreasing sharply on top of sustained GMV rates that continue to be above pre-COVID levels. And then by segment, their revenue from branded customers has increased 29% year over year. So I have to say this was stealthily a very good earnings report, because it shows that management is starting to get their act together on the customer support side. Normally, I try to stay away from linearly extrapolating results, but I think I can make an exception here. Specifically, I expect to see bookings continue to accelerate from here and their churn rate to continue to decline. So this is my first point here, which is this is a turnaround story, which is being supported by e-commerce tailwinds. Moving on to the second bull case, which is that this is more of a mid-stage e-commerce play rather than an early stage play. And what I mean by this is, so in the early stages of e-commerce adoption, the main beneficiaries within the space during the pandemic have been the companies that provide solutions to build out the online business itself. For example, Shopify, Evolution, and Wix, and so on. But once we get to the stage where companies already establish their online businesses and infrastructure, I think the next thing they're going to look for are the sort of secondary layer services that Channel Advisor provides. Because in many cases, it's not enough to just have the basic architecture. Like at some point, a lot of these businesses are going to have to invest in additional features like marketing promotion tools, first-party management, marketplace integration, analytics. And the thing is, not everybody is going to be able to afford SAP or Salesforce, especially when it comes to mid-market companies and smaller enterprises, which is why Channel Advisor has been the leading channel management vendor for almost a decade now, despite the poor customer service, which I talked about. Look, I've looked at their prices, and I wouldn't say their services are cheap, but it's reasonable. And there simply aren't other companies out there that provide full onboarding at a reasonable price. So now if we look at my annotated weekly chart, as we like to say at Jaguar, the bigger the base, the higher in space. And right now, it looks like the stock is starting to attempt to break out of a 5-year base as a result of the two separate bull cases that I just detailed. Now, in the near term, the key resistance level seems to be $22, where the initial blow off top coincided with the initial euphoria that we witnessed in a lot of e-commerce and work from home stocks. But since then, it looks like the stock has been consolidating above an important level of 1550. So I think we can revisit $22 and then reevaluate after that. Again, this is the one I've chosen not to go with for the upcoming outlook discussion, because there are some tail risks associated here, particularly to do with the method with which they implement their analytics gathering. Without getting too technical here, let's just say this method could eventually go obsolete down the road because of advancements in ad blockers. So if anyone's considering getting long, I would say treat this as a trade rather than something to buy and hold for the long term.
Even if it travels from $16 to $22 per share, that's 50% upside. Basically, a retest back to the highs of this year. That's a 50% above where the stock is where the stock is trading right now. How much time would you give it for it to travel? A year, 2-year horizon, or just basically follow it, just watch it? Because e-commerce is one thing that can change very quickly, right, from a sentiment standpoint, out of nowhere. But how much time would you give it, holding period?
I wouldn't give it more than a year, and in fact, I wouldn't be surprised if it gets there within a couple quarters.
Sounds good. Fantastic stuff. Interesting look. And I have to say, this chart does have a nice, very nice large wedge formation. So above $17, we would have a clear technical breakout. MACD and RSI is nicely rising for the last couple of days as well. So one to watch closely. All right, great stuff. A little bit longer, but a lot of content this time. So folks, we're going to stop here and we'll see you in the chat room shortly.